It's a nice morning. We meet again. This is a CPA Edwin OCHOI. So for today, we are going to talk about a consolidation, of which I'm going to do a question of advanced financial reporting, a question which was tested by CASNEB. So CASNEB is a body which offers exams in Kenya. That is for accountants. So let us check a question of that kind. So I've said consolidation. So this was the question. As I will share on the other side. So the question which was tested by CASNEB. So this is the question. So the question was concerning, so it's a question of December 2012. So they say Hunga Limited, a company quoted on the Securities Exchange, acquired 80% of Shika Limited several years ago. On 1st January 2012, Hunga Limited sold a half of the investment in Shika Limited and acquired 75% of the equity shares of Shujaa Limited. So you can see that this is a question of disposal, whereby a subsidiary has been disposed partially. Because now you are told that Hunga was a company which acquired 80% of Shika several years ago. But now coming on 1st January 2012, it is sold half of the investment in Shika. So since Shika was acquired up to 80%, remember Shika is a subsidiary, because it lies between the percentage of 51 to 100. So, but later, Shika was sold by Hunga a half. So if he sold a half of 80%, it remained 40%. So the investment of Hunga in Shika remained 40%. So which means that Shika changed from being a subsidiary to an associate, because you know that an associate is a investee company acquired by the parent between the percentage of 20 to 49. So now since 80% has been disposed by half, it will remain to be 40. And the 40 will lie between the percentage of 20 to 49. So we'll say that Shika, there's a period it will be a subsidiary, and there's a period it will be an associate. So these are disposal, which is partial, where the subsidiary changes to be an associate. So, and it acquired 75% of Shujaa. So which means that again, Hunga acquired another subsidiary called Shujaa. So the financial statements for the year ended 30th June 2012 for the three companies are given below. So you are given the relevant statement. So you are given a statement of comprehensive income. So we don't have to waste time reading that, because you know the items of an income statement. The same thing with items of statement of financial position as provided. So the main purpose here is all about understanding the additional information. So the additional information, they say, number one, Hunga Limited had acquired its shareholding in Shika for 2,400. So when the retained profit of Shika amounted to 1,500. So there was no fair value adjustment at the time of this acquisition. So you can see that you are told the time when Hunga acquired Shika, he paid 2.4 million. But as at that time, when Shika was acquired, retained earnings was 1.5. Then there was no fair value adjustment at the time of this acquisition. That is fine. Note 2, Hunga Limited sold a half of the investment in Shika for 1.5. So remember that when the question started up there, we said that Shika was sold by half. So that is why they are saying here, note 2, Hunga sold a half of the investment in Shika. So how much did he receive? 1.5, as told here. Hunga sold a half of the investment in Shika for 1.5. So this disposal has already been accounted for by Hunga Limited, but not by the group. So the fair value of the remaining investment in Shika was 1.3 on the date of disposal. But we are supposed to know that initially, as per note 1, when Shika was acquired, remember the investment, the amount Unga paid to Shika is 2.4, long time ago. But now, remember that after disposal, they disposed a half. So by the date of disposal, if you take your 2,400 times a half, it's supposed to remain 1,200. The investment is supposed to be 1,200 by the time of disposal. But here you can see note 2, the last sentence they are saying the fair value of the remaining investment. The fair value of the remaining investment in Shika was 1.3 on the date of disposal. And we know that it's supposed to be 1.2. So there was a difference of 100, which is a revaluation reserve on investment. Number 3, between 1st January 2012 and 30th June 2012, Unga Limited sold to Shujaa Limited goods worth 500 million, reporting a profit of shillings 100 million. So on this scenario, it was concerning intergroup sales of goods by Unga to Shujaa. So for 500, of which when Unga sold, he reported a profit of 100. But they're saying that the half of the goods were still in the inventory of Shujaa as at 30th June 2012. So which means that there is a profit which Shujaa never realized because he never resold all of the goods he received from Unga. So by the end of the year, that is June 2012, a half of the goods which Shujaa received from Unga were remaining in his stock. So we need to check the unrealized profit on the stock, which I can see it's direct, because here, when Unga sold to Shujaa the goods for at shillings 500, he made a profit of 100. So which means that for Shujaa to realize this profit of 100, he has to sell everything. That is the entire goods he received from Unga. But now, since he has not resold the entire, so to be specific, a half of the goods were never resold by Shujaa, he never realized the profit by half. So which means that the unrealized profit on the side of Shujaa would be 50, because that is a half of 100. But again, there's another way I can do it, because we know that unrealized profit on stock is all about the unsold goods times the profit margin, of which I know the unsold goods is a half of 500, that is 250, times profit margin. So here, to get profit margin, since it's not given direct, I will take my profit, you divide the selling price. Profit is 100, you divide the selling price of 500. So that is a fifth. So the 250, which are unsold, because I've taken a half times 500, I got 250. Then I've said profit margin is all about profit over the selling price. That is the profit you divide by the selling price, you get a fifth. So 250 times a fifth, that is 50. Number 4, intercompany receivables and payables were as follows as at 30 June 2012. So these are about the amount which is outstanding, which has not been paid from one entity to the other. So there was amount due from Shika to Unga of 200, and there was another one due from Shujaa to Unga. So under consolidation, you know that when there's an outstanding amount which has not been settled by either party, by the end of the year, we need to eliminate that. So we don't have to carry forward to the next financial year. So what you will do is all about you adjust your trade receivables account and a trade payables account with the amount which is outstanding. So with the amount outstanding which is due and it has not been paid by the end of the year, what you do to your trade payables account is debiting. Then you credit your trade receivables. So you have subtracted in both accounts. Trade payables debit, trade receivables you credit. And that is how you eliminate the outstanding balances, which has not been settled by the end of the year. Number 5, they are saying that as at 1st July 2011, a half of the goodwill of Shika had been impaired. So the goodwill was of the companies were not impaired in the current year to 30 June 2012. So the group uses partial goodwill method when preparing consolidated financial statements. So that's fine. This impairment, and we are told that when doing goodwill, we have to use partial method. But again, you need to know that it's not a must that they must be specific on which method to use when computing goodwill. But you need to understand that when doing goodwill, goodwill first is all about purchase consideration minus. You subtract, that is a share of net assets acquired. So we have two methods of computing goodwill: full method and partial method. For you to use full method, you must be given the fair value of non-controlling interest. So which means that in order to use full method, the non-controlling interest, the minority shareholders, that is, the NCI must be measured at its fair value. The goodwill arising from the use of full method goes to the parent and the non-controlling interest. Then in order to use partial, so there's nothing concerning NCI. So the NCI is not stated at its fair value. So which means that in this question, under additional information, you can't see anywhere they provided, they never provided fair value of that controlling interest. So automatically, even if they could have ignored telling us that we use for partial method, we could have known, because we were never provided with the fair value of non-controlling interest. That is fine. So we can start the question. So we will start the question from the point that you have to do the structured shareholdings, and then you check the timing according to the disposal, so that you know the time Shika was a subsidiary, and at the same time when Shika was an associate. Then you consider Shuja the time it was a subsidiary, because it was acquired during the year. So we start from the structured shareholdings. So structured shareholdings. So remember that there was a disposal. So which means that before disposal occurred, so before disposal, so Hunga was controlling Shika up to 80%. Then later, after disposal, now Unga sold a half of he sold half of Shika. So which means that Shika remained 40%. Then he acquired Shucha 75%. We have already gone through the question, so you know what I'm trying to interpret here. So those are the structures: before disposal and after disposal. Then after that, you talk about the timing. So according to the question, our financial year ends on 30th June 2012. So it starts on 1st July 2011. Then dispose of Shika, as told in the question, it occurred on 1st January. It occurred on 1st January 2012. And this is the same time they acquired Shuja. So this is what I'm trying to interpret. So you can see Hunga, a company quoted on Securities Exchange, acquired 80% of Shika several years ago. On 1st January 2012, sold half of the investment in Shika and acquired 75% of equity shares of Shuja. So our financial year, the financial statement for the year ended 30 June 2012. So we know that the statements, our statement is as at 30 June 2012. So that is where I'm getting the information from. So which means that Shika, for the first 6 months, because it was disposed here, for the first 6 months, it was a subsidiary. And for the last 6 months, it changed to be an associate. So that's why we say Shika, we have 6 months, 6 months subsidiary. So which means that this one, it was at 80%. Then again, Shika, 6 months associate, because after half is being disposed, it remained 40% for the last 6 months. What about Shuja? Remember that Shuja was acquired immediately on the date of disposal of Shika, which is 1st January 2012. So which means that again Shika, not Shika but Shuja, existed for the last 6 months from 1st January. So that is 6 months. 6 months subsidiary. 6 months subsidiary. So which means that is 75%. That is 75%. So after we are done with that, we can do now what is required. So what is required is to do the consolidated income statement and statement of financial position. So I will move with speed. So we talk about hunger. We have the consolidated income statement. So the consolidated income statement, so that is for the year ended. So for the year ended, so that is 30th June 2012. That is 30th June 2012. So we start with revenue. So for revenue, remember that you will be picking the transactions from your income statement the way they are. Because like revenue, I can see I have 80,000. This is 80,000, not 8 point something. This is 8,000. This is 4,500, and this is 6,000. So for Shika and Shuja, remember that they were existing as subsidiary for 6 months, 6 months. And you know that when you are doing consolidation, you take parent plus subsidiaries. So I will take the parent, 8,000 plus, I will apportion 4,500 by multiplying 6/12. Then Shuja was a subsidiary again for 6 months. So you take parent plus subsidiaries. So which means that Shika was a subsidiary for 6 months, Shuja was a subsidiary for 6 months. So 8,000 plus 6/12 times, so 4,500 plus 6/12 times 6,000. Then obvious under revenue, we only subtract under revenue. The only thing we always raise is intergroup sales. And these intergroup sales must be between the parent and subsidiary. So there was an intergroup sales in addition information number, so we can check that one. So there was an intergroup sales here under addition information number 3. So as at 1st January 2012 and 30 June 2012, Unga sold, that is Unga Limited sold to Shuja goods worth 500. Between which period? 1st January and 30 June. So which is between the current year, that is fine. And again, it was between parent and subsidiary. So that is the intergroup sales. We only subtract the 500. Then we move to cost of sales. So for the cost of sales, again, we take parent plus subsidiaries. Then we adjust with some items. So that is the case. So you can see 3,000, 2,000, 2,000. So parents and the subsidiaries. And for the subsidiary, remember to apportion. So 3,000 plus 6/12 times 2,000 plus 6/12 times 2,000. What am I supposed to subtract under cost of sales? The first thing you adjust here is intergroup sales. Then the next thing you add is the unrealized profit on stock out of those goods which were sold. So let us check for the unrealized profit out of those goods of 500. So the UPS. So that is my first working. So it will be unsold goods times profit margin. Remember that these goods of 500 were sold to Shujaa, but Shujaa by the end of the year never resold a half of the goods. Never resold a half of the goods. I think that one we read early enough. I don't have to share. So you can check note 3. So of which the unsold goods were half of the 500. A half of 500, that is the unsold goods. Then you have to multiply with profit margin. So we were never given margin, but we were told that the profit was 100 out of the goods of Hunga, which sold to Shujaa. He sold the goods for 500, making a profit of 100. So which means that I can get my profit margin. So my profit margin would be, I will take the profit, I will divide with the selling price. I will divide with the selling price. So the profit is all about 100. The selling price is 500. So I'm getting a profit margin of a fifth. So if I multiply a fifth, I'm getting 50. And remember that these goods were never resold by Shujaa by the end of the year. So I have to add that and realize profit on closing stock. I'm saying on closing stock because the goods were never resold by Shujaa by the end of the year. That is fine. So you can go to that additional information anyway, so that you can see what I was doing. Additional information number 3, you can see they said there was these goods which were sold by Hunga to Shujaa, worth 500, reporting a profit of 100. A half of the goods were still in the inventory of Shujaa as at 30th June 2012. So that's why I'm looking for a nearest profit on stock, because Shujaa never resold the goods he received from Hunga. He never resold the entire, he sold half. So out of the half which is remaining, there's a nearest profit. So which we calculate the way we have done. So which if you are not given margin, you can compute it the way I've computed there. And if you are given profit markup, you can change to margin. So if it was a markup right now, if you are given a markup of A over B, you change by taking A over B plus A. So that is how you change. If this was markup, your margin would be this way, A over B plus A. So that is the UPS on closing stock. And if there was UPS on opening, we raise UPS on opening stock. So the UPS on opening stock. So let's say these goods were sold between the two entities in the last financial year. So which means that they were never resold entirely by the entity which received them by the end of the last financial year. So we do the same thing, but now we raise because it would be the unrealized profit on stock for the previous financial year. Then after that, we need to check if there's depreciation undercharge and overcharge. So of which depreciation that is undercharge, depreciation under will be added, and the depreciation overcharge will be subtracted. So we say minus depreciation overcharge, then we add depreciation undercharge. But remember that you don't have to get depreciation overcharge. We always take unrealized profit on fixed assets times depreciation rate. And if you have a remaining useful life, you know that you have to divide. You cannot multiply. So in order to get this unrealized profit on fixed assets, you have to take the transfer value of the asset. So the transfer value of the asset times profit margin. So which means that in order to compute these two things, you must be provided with sale of fixed asset. So there must be a sale of fixed asset. For example, if Unga sold a fixed asset to Shuja at a profit, then remember that a fixed asset is not meant for resale. So once Shuja will receive the asset, he will never resell it. So which means that since he received from the other entity and he will never resell the asset, remember, he will never realize the profit because when he was receiving it, he paid plus a profit. But on his case, he will never resell the asset. It would be used for the business purpose. So since he will never realize the profit, we have to check for the unrealized profit so that we adjust the property plant account and the retained earnings account. Then, since there was a sale of a fixed asset between the two entities, so the one which was selling to the other one had already charged depreciation. Then the other one which received again the asset charged depreciation. So which means that since they are group members, it would be a sale between parent and subsidiary. So if it was a sale between parent and subsidiary, and that is the only case we consider, and the two of them charge depreciation on the asset, we obviously know that that is a double depreciation. We call it depreciation overcharge, but it will be computed after you get the unrealized profit on fixed assets, then multiply with the depreciation rate. Then for the depreciation undercharge, it's all about revaluation gain. Times what? Depreciation rate. But if you have a remaining useful life, you take revaluation gain, you divide with the remaining useful life. So of which you know that revaluation is the difference between the fair value, which is called the market value of an asset, and its carrying amount, or the net book value. So difference between fair value or market value and the carrying amount, or net book value. That is what we call revaluation gain. So in short, that is what we call revaluation. So those all explanations I've made, there was none. They never tested us concerning the sale of fixed assets so that we can determine overcharge for depreciation, and they never tested anything concerning revaluation so that they can compute depreciation undercharge. So that after this, we are supposed to get a gross profit. After the gross profit, we move to other incomes. So I can see in the question, you are given dividends and you are given gain on disposal, but this one can be a gain stroke loss on disposal. So this one is direct from the question. So of which, if I go to the question, so you can see dividends for the parent, for the column of the parent is 380. Then gain on disposal is 300, but I cannot record this 300, I need to do a working. So for dividends, remember that these are the dividends which were received from the other investee companies. So Shika and Shuja. So you can see down here, after profit after tax, there's a dividend paid. Shika paid 200, Shuja paid 400. So we have to subtract them from this 380. because this is what the parent recorded. So these 380 include the dividends received from the investee companies. And that's wrong. The parent is not supposed to receive dividends during the year, because by the end of the period, it would get the entire profit from the investee companies. So we have to subtract. We have to subtract the dividends paid by investee companies. So the 200 and the 400, but I have to check with the share, which the parent controls them. So here I will minus, so I will take 380 minus. So remember that the parent controlled Shika 80%, but Shika paid 200 as dividends. And remember, this one was disposed by half. Then you minus again. You control Shucha 75%, and the Shucha paid 400 as dividends. So we subtract that. And if there was any interest, which was again paid, we subtract. But there was no interest, which means that there was no anything concerning interest. And for gain or loss on disposal, this one needs a working. Maybe when I will be doing my goodwill, if I get a negative goodwill in any scenario, I would have to record it as an income. So which means that again, I would check this. If my goodwill comes to be a negative, it will be recorded there as an income. So that one, my workings will determine. And that one will be done later. For expenses, we start from the distribution cost. So for the distribution cost, it's 1,200 for the parent. Then we apportion, subsidiary was there, that is Shika was there for 6 months. Then plus 6 over 12 times, 800. Then admin, that is administrative cost. I will write in short, admin, 1,800 plus 6 over 12 times 800 plus 6 over 12 times 1,200. That is 1,200. Then before I record my finance cost, because that is the next expense, so this is what I've been doing. So I've done distribution cost, administrative cost. Then now the next is finance cost. Before I record finance, I have to introduce a new expense, which is not here. That is impairment. So I have to record impairment, loss. And that one will be determined from goodwill. So this one I will write working. I will just skip. So that we have profit before interest and tax. So profit before interest and tax. So that the interest now is all about finance cost. So I will introduce the finance cost there. So the finance cost is 200 plus for Shika. Shika was there for 6 months, and the Shucha was a subsidiary for another 6 months. So now, before we subtract tax, remember that we have been considering Shika for 6 months, the first 6 months when it was a subsidiary. So which means that there is another period when it was an associate. So from that associate, the parent will requisition for an income. After that, associate has paid tax. So which means that I will take share of profit after tax, share of profit after tax. So the share of profit after tax. So the share of profit after tax in associate. And remember, it was just Shika, which was an associate for the last 6 months. So it was 40% of So the profit after tax of Shika, but I will apportion it for the last 6 months. So it was 700. So we take 700, but now for the last 6 months, that is what the parent will get. So that here we have a profit before tax. Then after that, I will raise income tax. So income tax, remember that it's the parent and subsidiaries, because for the associate, I have taken profit after tax, then I have shared. Because now that is the income the parent will get. So anyway, income tax is for the parent and subsidiaries. It's all about 600 for the parent, plus for the Shika for the first 6 months, that is 300, plus for Shuja for the last 6 months, it was 400. Then after that, we get profit after tax. So profit after tax. So after getting profit after tax, then I will say profit attributable now to the NCI. Then profit attributable to parent. So profit attributable to NCI and the profit attributable to parent. That is fine. So we can get the answers for the one we have already computed. So if I take my calculator, I do the first revenue, that is 800 plus 6 over 12 times 4,500 times 6 over 12 times 600 minus 500. So for the first one, I'm getting 12,750. And if I do the next one, the next one I'm getting 4550. So I take 12,750 minus answer, that is 8,200. Then the other one is this one is 0. So these two needs workings. For distribution is 1900, 1900. For the admin is 2800. Then this one needs a working, that is impairment. This one is direct, this is 50, 50, 100, this is 300. Then here is 350 times 0.4. That is 140. And this is 150 plus 250. That is 400. 400 plus 600, that is 1,000. Up to that point, that is fine. So profit after tax. So the others needs are working. Even the profit attributable to the NCI needs are working. So let us start with the first working. So for the gain or loss on disposal. And so let us do another working here, gain stroke loss on disposal. So we start from sales proceeds. So for the sales proceeds, so this one will determine here. Then we raise share of net assets disposed. Then we raise an impaired goodwill. An impaired goodwill disposed. Then finally we raise dividend earned and disposed. So dividend earned and disposed. So sales proceeds were there from additional information number 2. So the sales proceeds, I think it was 1,500. So we can confirm. So they said no too. Unga Limited sold half of the investment in Shika for 1,500. That is fine, 1,500. Share of net asset disposed. That one needs a working again. Share of net assets disposed. So share of net asset disposed. Remember, these are equity items I would check for Shika. So of which I go to the equity part of the question, which is under the statement of financial position. So under that statement of financial position, under equity, I can see under equity. So these ones, I can say I have 1,000 and 3,000 for ordinary share capital and retained profit. So we have ordinary share capital. So ordinary share capital is 1,000. Then retained profit. So I cannot take the 3,000 direct because this one must be as disposal date. As disposal date. Your retained earnings must be as a disposal date. So which means that the one which you are given is at the end of the year, 13,000. It was 13,000 or 3,000. So that is 3,000. So the 3,000, it was at the end of the year. And remember that as a disposal date, it was first, because it was first, what? 1st January. That is 1st January. At the start of the question, I think these are the things we already interpreted. And we know that our financial year was ending on 30th June 2012. So it was starting 1st July 2011. So I need to get as at this date, as at 1st January, which means that it's for the first 6 months. As at 1st January 2012. So of which the one we are given is as at the end of the year, because that figure is from the statement of financial position. And the statement of financial position is prepared as at 30 June 2012. But now we need as at 1st January, of which we know that our profit for the year, the profit for the year, from the income statement, that is profit after tax, is a certain figure there. So that one is the one which we consider. So for the year, the profit for the year, that is profit after tax, was 500. So you can see retained profit for the year under the column, under the middle column. So this is 500. That is the profit for the year, retained profit for the year. So the 500. So we have the 500, that is for the year. So in order to get for the first 6 months, obviously I will take the 3,000. Remember again, the last 6 months, the last period is the 6 months. So I will subtract the last 6 months. This period, I will apportion the 500. Or I can see again we were given brought forward. So if you go to your income statement, I can see there was a retained profit brought forward. So there was a retained profit brought forward of 2,500, this one. So if I record 2,500 at the start here, again I can take the 2,500. I will add my first 6 months. So which means that for the year, I have to apportion it for the first 6 months. Then I will add the balance pronoun to that first 6 months. But if you start from the balance carried forward, that is at the end of the year, I have to subtract the last 6 months. So which means that that is 2,500 plus 250. That will be 2,500 plus 250. That will be 2,750. And here is 2,750. So which means that this is 2,750. So the total here is 3,750. But now, remember that we were looking for the one which was disposed. Out of the 3,750, the total net assets, the parent controlled 80%. Then it disposed a half. It disposed a half. So which means that I will get, if I use my calculator, that one I'm getting 1,500. So this one is 1,500. So 80% of that 750 times a half. So which means that is what we are looking here. That is what we are looking for. Then for the unimpaired goodwill, I have to do now the goodwill. I have to do the goodwill. So which we know that the goodwill will use partial method. So which you know that goodwill is all about purchase consideration. You minus the share of net assets. So share of net assets. So since it's a partial method, I can do both companies at the same time. I can do Shika and Shuja. Because obvious, the goodwill from Shika will go to the parent and this one is to the parent. There is nothing going to the NCI. So I can do both companies at the same time. So I start with purchase consideration. So for the purchase consideration, so when the parent was acquiring Shika, he paid 2,400. So that one is given in the additional information number 1. Then what about when he was acquiring Shuja? So let's check in the additional information. So you are told that additional information number 1, Unga Limited had acquired its shareholding in Shika for 24, that is fine. But to get for Shika, remember that if you check your non-current assets, you are given the investment in Shika is 1,200 because they have taken 2,400 times a half because a half was disposed. That's why they are getting 1,200. But remember, goodwill we compute from the time of acquisition. So which, as at the time of acquisition, when Shika was acquired, the parent paid 2,400. That is why I'm going with the 2,400, but not the 1,200. But for Shuja, it will be this 1,800. I will record the 1,800. So this one, which is given there, that is the purchase consideration. Then we have to raise share of net assets. So for the share of net assets, we have an ordinary share capital. I will write in abbreviation. So for Shika, I remember it was 1,000. That one you check from the statement of financial position. So you take 80% times 1,000. That is for Shika. For Shuja, it was 75% of. So 75% of what? So let's check. So you can see it was 1,000 again. 1,000. So that is given there. So 75% of 1,000. I've said that the goodwill will compute from the time of acquisition. That's why you can see under Shika, I'm using 80%. As at the time of acquisition. Initially, it was acquired at 80%. Then we have to talk about the retained earnings. So retained earnings, this figure must be as at acquisition. So as at acquisition. So which means that for Shika, this one was given direct. The parent was acquiring Shika as a note 1 when the retained earnings was 1,500. It's given in note 1. I can show you that. So note 1, Unga Limited had acquired its shareholding in Shika for 2,400 when the retained profit of Shika amounted to 1,500. That is fine. But for Shuja, you have to compute. You have to compute. So again, we have to draw something here. So remember that our financial year was ending on 30th June 2012. So it was starting on 1st July 2011. And remember that Shika was acquired 1st January 2012. The time they disposed Shika, Shuja was acquired. So it's 6 months, 6 months. So for Shika, that is not Shika, but Shuja, for Shuja, the retained profit carried forward is given. You can check even from the income statement. So you are given balance brought forward, carry forward, and profit for the year. That is what we need to interpret. So from this column, the last column there, you can see retained profit brought forward is 1,500. Carried forward is 2,500. And the profit for the year. Profit for the year is 1,000. That is profit after tax. This 1,000. That is for the year. So that is what I've recorded down there. So the 1,500 brought forward, 2,500, then 1,000 for the year. So which means that in order to get as at the time of acquisition, this time here, I can take my 1,500 for the start. I would add the first 6 months, but I have to apportion the 1,000. So that is 2,000. The answer there. The answer there is 2,000. Or I can take the 2,500. I will minus the last 6 months times the 1,000. So it will be 2,000. So that is the 2,000. The 2,000 is the one you take 75% of the 2,000. So that is fine. So what I'm getting there is all about, this one is 1,200. So for the first one, this was 800. And this one is 750. Then the next one is all about 1,200. And the 1,500. So this was 1,500. So then another thing I have to consider is all about pre-acquisition dividends. So pre-acquisition dividends, and these pre-acquisition dividends to be applicable, the investee company must have been acquired during the year. So which means that Shika was acquired several years ago. This one can never have a pre-acquisition dividends. But remember that Shucha was acquired during the year. So of which pre-acquisition period, we can even see here, pre-acquisition period would be the first 6 months. The pre-acquisition period would be the first 6 months. So I will take my first 6 months times the dividends which Shucha paid. So you go to the income statement, check the dividends which he paid. I think it was 400. So that one was 400. So this one, I can show you where I'm getting the 400 from. So this is the dividends. So dividends paid. So the 400. That is the relevant dividends which Shucha paid. So the dividends paid, we have determined it was 400. So for the pre-acquisition period, then remember you have to multiply with 75%. So there I'm getting 150. So that is 150. So which means that my goodwill, for the first one, if I use my calculator, so 2400 minus 800 minus 1200. So this 400. So this one even is direct because this plus this is 2000. Then this one will be, so 1800 minus 750 minus 1500 minus 150. That is a negative of 600. So this one we said is supposed to be an income, a negative goodwill. So that we consider if there was impairment. If there was impairment for Shika, because already we can see for Shuja, it has a negative goodwill, and a negative goodwill, it's supposed to be recorded as an income. So for impairment, so they say as at 1st July 2011, note 5, a half of the goodwill of Shika had been impaired by 1st July 2011. So which means that by the start of the current year, a half of the goodwill of Shika had been impaired. We can't say that that is the impairment for the year, but that is the impairment from the time of acquisition, because the goodwill we have computed for Shika is from the time Shika was acquired. So by the start of the current year, which is 1st July, the goodwill we got from the time of acquisition of 400 has been impaired by half. So that one we call it accumulated impairment. So this one is accumulated. So accumulated impairment. So half of the 400, I'm getting 200. So that I'm getting 200 here. So unimpaired, so that is now the unimpaired goodwill. Unimpaired goodwill. So if we go back to the question again, we can check if there was any impairment for the current year. So was it there? So we can read note 5, as at 1st July 2011, half of the goodwill of Shika had been impaired. So which we have said that is accumulated impairment. So the goodwill of the companies were not impaired in the current year to 30th June 2012. So which means that there was no impairment for the current year. There was none for the current year. So which means that here they disposed, out of the unimpaired goodwill, they disposed a half. So unimpaired goodwill disposed is 100. So the undisposed is 100. So what I was looking for is the unimpaired goodwill disposed. So unimpaired goodwill disposed, you can see we are getting 100. Then finally, we can do something concerning dividends and undisposed. So dividend and undisposed. So dividend and disposed. So for the dividend and undisposed, we will check the entity which was disposed paid which dividends. Then we check the parent and what percentage. Then they disposed which fraction. So remember that Shika paid a dividend of 200, and this is the 200. So we go to the income statement. So this is the dividend which was paid by Shika. So the 200. So the 200 was the dividends paid by Shika. So the parent earned. So remember that the parent controlled 80% of the 200. So you earned 80%, but for 6 months. So that one I'm getting because this is all about 100 times 80, that is 80. So parent that is disposed of. So they disposed of a half of the 80. So which is 40. So which means that here I'm getting 40. So this minus this plus minus that one would be cancelled out. Then I can see that the answer is 140, which is a loss. So that is a loss of 140. So this working we have done, at some point, it can be a requirement in your exam scenario. Like now for the question of December 2017, it was a requirement that A, compute gain or loss on the disposed subsidiary. So which means that the loss will be recorded in the income statement as an expense. So we record here 140. So this is what I was looking for. Then I said if we got a negative goodwill, remember we got a negative goodwill of 600. This one for Shuja. So the 600 will be recorded as an income. So that we said that there was no impairment for the current year. So this is dash. That is what they said in the last additional information. Even if we did the goodwills, the only thing which was there was accumulated impairment for the previous years, but in the current year, there was no impairment. So which means that I can get my profit before interest and tax there. So I will use my calculator. I will take 8200 minus 140 plus 600 minus 1900 minus 2800. What I'm getting here is all about that is profit before interest and tax of 3916. That is from my calculator. So you can also confirm that is 3960. Then I minus 300 plus 140. So this is 3800. Then minus 1000. This is 2800. So that we check if there's profit attributable to NCI, then profit attributable to parent. That will be our last working for the income statement. So the profit attributable to the NCI, that is non-controlling interest. Profit attributable to NCI. So the profit attributable to NCI. So what you do here, in order to get this, you have to adjust the profit after tax in subsidiary. You have to adjust the profit after tax in subsidiary. And we know that you have two subsidiaries. That is Shika for the first 6 months and the Shuja for the last 6 months. So the profit after tax for Shika, it was 700. So this is, I'm getting 350. Then for Shuja, it was 1400. So 6 over 12 times 1400, because Shuja was a subsidiary for the last 6 months. So that one is, I'm getting, the answer there is 700. So this one is from the income statement. Profit after tax is direct in the statement. It's only that you apportion the time they were subsidiaries. So to adjust this, you have to raise UPS. If sales, upstream. Then you have to raise depreciation, undercharge. Then you have to add depreciation, overcharge. Then you have to raise impairment loss. But in order to raise this impairment loss, they must have used the full method in the computation of goodwill. Because when you use the full method is when at least you get goodwill from the NCI and the parent, then you impair. So why am I raising UPS? I start with this, and it must be a sales upstream. So this on a scenario that if the subsidiary was selling the goods to the parent and the parent never sold the entire goods, so which means that the parent never realized the entire profit with the subsidiary realized. So which means that the profit of the subsidiary is overstated by what the parent never realized because he never resold all the goods he received from that subsidiary. So on our question, it was a downstream sale according to additional information because you were told it's the goods which were sold by Unga to Shujaa. Unga to Shujaa. According to note 3, you can see Unga Limited sold to Shujaa. That is a downstream. So it's not there. Then for the scenario of depreciation under change, there was no revaluation. That one I explained earlier. In order to get depreciation under change, you must have revaluation gain. You multiply with the depreciation rate. Then for the overcharge, you must have a sale of fixed asset. There was none. Then for impairment loss, I said we must have used the full method. We never used the full method. We used the partial method. So which means that this is the way you could have adjusted your profit. So adjusted profit, this 350 and this 700. So in order now to get the NCI profit, it's all about you take 20%, yes, because for Shika it was 20% times 350 plus 25% of 700. So here we have to compute. So using my calculator, well, I'm getting 245. So which means that here is 245, profit attributable to NCI. So what goes to the parent, you take 2800, you minus the 245, 45. So here you get 2555. So 2555 goes to the parent. And that's all for the income statement. But now, if you were in an exam scenario and you could have avoided, let's say, the workings, and you do the easy workings, the easier ones, you could have scored the first one. The second one is easy. Even the third one is easy. This one needs a working. This one needs a working. Then you could have scored this and this. Even this one is easy. Even this one. So you can see the only thing which needs working is some few items here. So the gain or loss on disposal, you have to check if after getting your goodwill, was there any negative goodwill you record there? Then add this one. So out of the entire equation, you could have scored 80%, even if without the workings I'm doing. But for you to balance the equation and to go for the award, to be an award-winning student, you have to do the way I'm doing. Even the workings you have to calculate. But if you want us to pass exams, you can also apply the concept of doing first the easy items, then you can even leave away the workings. So once you have the easier ones, those are enough for you to pass the paper. But remember again to gain the knowledge behind consolidation. So let us move to the next part, which is now the statement of financial position. So these are continuation. Now Hunga Limited. So this one here will take a little time. So Hunga Limited. So that is all about consolidating statement of financial position. So that is as at. So our financial year was ending on. So remember, the statement of financial position is prepared by the end of the year. So as at 30 June 2012. So I start from the first item, non-current assets. So write in short, 9 here, non-current assets. So PPE, property, plant and equipment. So you take the parent plus subsidiary. So on this scenario, it was a bit challenging, because again you have to identify which items you have to pick. So for the parent is Hunga. For the subsidiary, I have to pick only Shuja. Why am I not picking Shika? Remember that Shika was disposed during the year. So by the middle of the year, it was disposed by half. So by the end of the year, Shika was an associate. So, and remember that the statement of financial position is prepared by the end of the year. And we know that under consolidation, we always add parent plus subsidiary. And the Shika was an associate by the end of the year. So we cannot pick that. So for the associate, I will only account for it using the equity method under the International Accounting Standards 28. Under the International Accounting Standards 28. So which means that I will be taking parent plus subsidiary. So my parent is Hunga, my subsidiary is Shuja. Because Shuja, by the end of the year, it was there and it was at 75%, because it was acquired at the middle of the year. So by the end of the year, it was a subsidiary. But for Shika, I have said it was an associate by the end of the year, because it was disposed by half in the middle of the year. So I will take 6,800 plus 3,000. And remember that the transactions of Shuja, you don't have to apportion. Even if the subsidiaries acquired 1 month to the end, never apportion its transactions under the statement of financial position. You take the all figures. So we take my 6,800 plus 3,000. I will add revaluation. So in short, I would say REF. So there was no revaluation, because I said revaluation to get that is the difference between the fair value of the asset and the book value. There was nothing like that. Due to revaluation, there is a depreciation under change. You subtract. Again, you subtract UPFA. Then you add depreciation over change. So for you to get UPFA and realized profit on fixed asset, that is, and realized profit on fixed asset, there must be a sale of that fixed asset. So those items were not there, but already you know how to do them. Again, try to go through my channel. I have made videos which I have explained these things, and even the questions of section 3, financial reporting. Again, I have done some consolidation questions. After that, we move to the next thing. So the next thing, remember that is all about, according to the question. So according to the question, the next item is investment. So the investment, you can see our total investment in Shika, and the Shika, you know that we have said it was an associate by the end of the year. So we will account for it using equity method in order to recognize that. Then investment in Shuja, remember that I could have recorded the goodwill if it was a positive, but it was a negative goodwill for Shuja. So since it was a negative, we recorded as an income under the income statement. So for now, the only thing I will record, I will replace with is the investment in Shika, of which I will say investment in Shika or investment in associate. I will come later to do a working using equity method. So investment in associate, which is Shika. So this one I will use the equity method to do this working. Then after that, I have to move to other items. So we will be moving downwards. So after that, we are done with the non-current assets. We move to the current assets. So under the current assets, I will take my inventory. So inventory is all about parent plus subsidiary of 1200. So here we have to raise UPS and here is profit on stock. So and I remember very well we did this, it was 50. So this is what I was looking for. So we did this one and we got 50. Then after that, if there was any goods which were in transit, so one entity sent them and they were never received by the intended party. So we need to add because they will be received and your stock will increase. Goods in transit. Then after that, we move to the another item, which is all about receivables. So for the receivable, I will take 4,000 plus 3,400. So on this scenario, you have to raise anything which was outstanding between the parent and subsidiary. I explained earlier enough when we started the question, I said, if there is any outstanding balances and the amount has not been paid by the end of the year, we always forgo that amount by debiting trade payables and crediting our trade receivables. But these outstanding amounts must be between the parent and subsidiary. So if you go to note 4, there was an amount which was due from Shika to Unga, but now Shika, we know it's an associate by the end of the year. So I will consider the amount due from Shuja to Unga, the 300. So I will subtract under this receivables. Then when I will be doing my trade payables, again, I will subtract. So which means that I could have debited under trade payables and credited under trade receivables. Again, if there was cash in transit, we subtract. But this was amount sent by one entity and it was never received by the other by the end of the period out of the outstanding amounts. Then after you have subtracted cash in transit up there, you add under the cash at bank. So we have cash at bank. So the cash at bank is 1,000 plus 600. So if there was cash in transit, because obvious, even if it was transit and it was never received by the end of the year, it will be received on a later date. So you have to adjust your cash account. So you add their cash in transit. So up to that point, we have total assets. We have the total assets. Then after total assets, we talk about equity and liabilities. So for equity and liabilities, we have the ordinary share capital. So for the ordinary share capital, remember that you go for the parent. So that is 6,000. Then we have the retained profit. So retained profit, I have to do a working. Then after that, there is something we need to introduce new, which is not in the question. So let me show you the statement so that you know what item I'm introducing, which is not there. So if you go to the balance sheet, this is the balance sheet. What I've been doing is just, is taking the parent plus subsidiary, which is Hunga and the Shuja, then I make adjustments. But once I'm here under this equity, I've taken ordinary share capital for the parent. Then I can see we have retained profit. Retained profit, I've said we can't take direct, we have to do a working. Then there's something which is not here. So concerning non-controlling interest. So for us to get their capital, so we have to do a working for non-controlling interest, the NCIs. So non-controlling interest. So this one needs a working. Then after that, we move to the non-current liabilities. So under non-current liabilities, what I have is 10% loan stock. So this is more direct. You just add 2,000 and 1,000. So parent plus Shuja, parent plus subsidiary. Then finally we have current liabilities. So for the current liabilities, we have trade payables. So for the trade payables, I take 2,500 plus 3,300. I have to minus the one I said which was outstanding, this one. So once I minus here, I have credited. Once I minus here, I have debited. So that is how you cancel out the amount which was outstanding and which was not paid by the end of the year. Then another thing you can add here is goods in transit. The one which were in transit and they were never received by the intended entity by the end of the year, and they were on a credit. That is why I'm increasing my trade payables. At the same time, once they will be received, you will increase your stock. Then finally, we have a current tax. So for the current tax, we take 300 plus the 400, another free mark. So we have total equity and liabilities. So this one is 700. The next one is, so this one I can see we can add direct. This one is what about 25 plus 33 minus minus 300, that is 55. This is 3,000. These and these needs are working. Then for the cash at bank, that is 1,000 plus 600, that is 1,600. Then 7,400 minus 300, that is 71. That is 7,100. Then the other one is 1,500 plus 1,200 minus 50. That is 2,650. And again, this one needs a working. Then the first one there is 68 plus 38. 68 plus 38, that is 98. That is fine. So let us do the three workings. But for the exam scenario, what you have recorded is even more than enough. Because these are around how many points? 1, 2, 3, 4, 5, 6, 7, 8. And they were in need of 10. So you have 8 out of 10. Remember, they mark one correct entry for 1 mark. So let us do now the investment in. So they're working for investment in associate, then we do retained earnings and the NCI. Investment in associate. So for you to get investment in associate, you have to recognize the associate with initial cost of investment. Initial cost of investment. So initial cost of investment, you record there. Then after that, so initial cost of investment, remember that it was 1,200 because by the time of acquisition, they paid 24. This, remember, it's Shika. When Unga was acquiring Shika, he paid 2,400. But by date of disposal, they disposed the half. So it's supposed to be 1,200. Then what you add is the share of post. Share of post acquisition profit, share of post acquisition profit, or reserve. So post acquisition profit or reserve. So for the retained profit, profit, so remember it was 40%. So in order to get post acquisition profit, you take the balance carried down, you minus the balance as acquisition. The balance carried down was for Shika. Remember, we are dealing with Shika. The balance carried down was, you go to even the income statement or the statement of financial position. So it was 3,000, this one. By the end of the year, 3,000. So you take 3,000 minus the balance which was there as at the time of acquisition. As at the time when Shika was acquired, not one, it was 1,500. You can see when the retained profit was 1,500. That is fine. So that is what I've taken. 3,000 minus 1,500 times 40%. Then for the revaluation reserve is the one which was concerning investment. Because they said according to note 2 or note 3, let's check. They said that the investment was 13 instead of being 12. This note 2, there are sentence, this one. So that statement, they said that the fair value of the remaining investment in Shika was 1,300 on the date of disposal. The fair value of the remaining investment. And we know that the investment, as at the time of acquisition, it was 24. So by the date of disposal, they disposed the half. So it's supposed to be 24 times a half. It's supposed to be 1,200, but they are saying it's 13. So it's more by 100. It's more by 100. So you take the 40%, you multiply with 1,300 minus 1,200. So this is 40. Then the other one, 1,500 times 40%. This one I'm getting 600. Then what you always raise is concerning impairment. But there was no impairment. They told us in the last additional information that they were never impaired. There was no impairment for the current year. Then the only thing I will add here is undisposed goodwill. So undisposed goodwill was 100. So I can show you where we got 100. So remember that when we did our goodwill, we got a goodwill of 400, of which accumulated impairment was 200. We got an impaired goodwill of 200. They disposed the half of the 200. So undisposed was 100. So if we add, so this is 18 plus 100, 19, so 1940. So that is what you are supposed to record here. Then I forgot to record that revaluation. So remember the revaluation reserve was supposed to be recorded here. So the revaluation reserve, the 40, this 40. So let us finalize with the other two. So I will start with the NCI account. So remember that on this side we have net assets like ordinary share capital, retained earnings, things like so those are some of the items. So for the ordinary share capital for Shika, remember that the NCI concerns not Shika but Shuja, because Shuja is the one which was subsidiary by the end of the period. So you have to consider the 25%. Then we have 25% of those items from the income, from the statement of financial position. From the statement of financial position. So the two, so the 1,000 and the 2,500. So the two, ordinary share capital and retained profit. So the 1,000 and the 2,500. So this is all about 250. Then the other one, then this one is 525. Then here we have to introduce goodwill of NCI, but we don't have the goodwill of NCI because we never use the full method. Then another thing you need to record here is depreciation overcharge. So for the goodwill, we have, I can see we have dash there. So we introduce goodwill of the NCI. So which remember that we never use the full method in order to get the goodwill of the non-controlling interest. Then I've said here, the goodwill, then we record depreciation overcharge, not undercharge. It was not there. But remember that we have to apply the percentage of NCI. Then we have UPS. If sales, upstream. It was a downstream because Hunga sold to Shuja. The depreciation undercharge, if it was there, there was none. Then here we record impairment loss. There was no impairment loss. So which means that our balancing figure will be 875. So it would be 875 here. To consolidated statement of financial position. So the 875. So this is what we record under this. 875. That is non-controlling interest, for the non-controlling interest. Then let us finish now with the retained earnings. So for the retained earnings, so this one is the same as the statement of changes in equity. So if you are told to do the statement of changes in equity, the same thing I will be doing here is the one you could have done. So we start with the retained profit balance brought down. Retained profit balance brought down. So for Hunga and for Shuja and for Shika at the same time, then you add profit for the year. Add profit for the year, but now profit for the year for the parent, that is from the one we got under the income statement, which we just prepared. Then after that, we raise dividends. Dividends paid by who? Parent. That is fine. Profit for the year, I can start from that. For the year to the parent is the one we got here, this one. Profit attributable to parent from the income statement we prepared. So 2555. 2555. So this one is 2555. Then for the dividends paid by the parent, that one is direct from the income statement. Under the column of the parent, you check the dividend it paid. So dividends paid by the parent. So it was this 500. Under dividends paid. Dividends paid on 30th April 2012. For the column of the parent, it's 500. So this one is supposed to be 500. Then for balance brought down of Unga, that one is also direct from the income statement. Retained profit brought forward. This one down there, the second last low. So retained profit brought forward 4120. So remember that this one is for the parent there. Then for Shuja, it will be 0. Because Shuja was acquired during the year. So if an investing company is acquired during the year, its balance brought forward will not be there because it came into existence during the year. So in order to have a retained profit to brought forward, it must have been acquired from the previous years. So that the retained profit for the previous year is what to brought down in the current year. So since Shuja was acquired in the current year, we cannot have a brought forward. But remember, Shika was acquired several years ago. It was acquired several years ago. And this one was 80%. So the balance brought forward was for Shika. The one which is given here is 2,500. But remember, as at the time of acquisition, there was 1,500 as note 1. Retained profit of Shika amounted to 1,500. Remember that 1,500 is included in the 25. So you have to take 2,500, you minus the 1,500 to get the correct retained profit brought forward for the current year. So that is 2,500 minus 1,500, that is 1,000 times 80%, this is 800. So that if you take 4120 plus 800 plus 2555 minus 500, you get 6975. So that is now the retained profit carried down. So that is what we record here. 6975. And that's all for this question. So let's check if it's balancing. So you take 98 plus 1940 plus 2640 plus 71 plus 1600. That one I'm getting 23,090. Then for the equities and liabilities, you take 6,000 plus 6975 plus 875 plus 40 plus 3,000 plus 5,500 plus 700. I'm getting the same, 23,090. So that is the end of the question for December 2012. And this question was concerning partial disposal of a subsidiary. Partial disposal of a subsidiary. And the subsidiary changed to an associate. Partial disposal of a subsidiary where the subsidiary changed to be an associate. So at the same time, if it could have changed to be a joint venture, you know that the joint venture, again, you account for the transactions of the joint venture the same way you account for the associate. So the way you deal with associate is the way you deal with joint venture. And already you have known at the same time how to deal with subsidiaries. And this is the question which is mainly tested in advanced financial reporting. That is section 6. So guys, you can have a nice day. We meet next time. And at the same time, never forget to click on the subscription button and the notification so that once I will be recording another video, you will be notified. And at the same time, remember to share with your friends. And whoever needs a physical class, I always provide private classes at your comfort. Zoom classes, that is. Even physical classes, I'm in Nairobi. So I can move, I'm free to move even to your office and provide my service. Or we can meet in town. For the college, some may like to know where I teach. So I offer my services at RCM, that is RCM College. And so the RCM College is the one which is at Commonwealth, opposite Garitos, around Moy Avenue, 50th floor. So we always do wonderful things there. So always never forget again to give me a subscription and remember to share with your colleagues. I know it's many guys who are doing these things concerning finance. So you can have a nice time. We meet next time on another video, or some we interact physically in the Zoom classes. Whoever would like to subscribe, you can be able to reach me through 0728-760-546. Or you can check on my social media platforms. For Facebook with Edwin OCHOI, and for Twitter is Edwin at Edwin OCHOI. My Twitter handle is at Edwin OCHOI48. And at Instagram is Edwin OCHOI. So have a nice day.